Today, we are looking at a real giant in the pharmaceutical world, a company that's truly shaping global health and, well, creating a ton of debate on Wall Street.
Novo Nordisk.
Novo Nordisk, trading under the ticker NVO. They are, of course, the company everyone knows as the king of weight loss.
Thanks to Ozempic and Wegovy, yeah.
Okay, so let's unpack this. We've gone through a really comprehensive analysis report, and it makes a bold claim. It says NVO, which is trading right now around the $52 mark, is just fundamentally mispriced.
Seriously mispriced. The analysts suggest it's on sale, a huge discount.
And not just any discount, they believe it might be the single best risk-reward play in the entire market right now. So our mission in this deep dive is to see if the cold, hard data actually backs that up.
And you really have to set the stage here because you need to understand why the price is where it is. Novo Nordisk has been severely beaten up.
Right.
The company is trading roughly 40% below its recent highs. And this massive drop, it isn't because of failed trials or poor sales or anything like that.
No.
It's fueled entirely by fear. Specifically, panic selling over future competition.
Mostly from Eli Lilly.
Exactly. So the analysis we looked at frames this perfectly. We're looking at the case for buying the fear.
Buying the fear. And, you know, if that fear is irrational, that's often where the biggest opportunities are. But for that to work, you need a catalyst. Something big has to change. So what happened? What news dropped that, according to this report, flips the entire narrative?
Well, the big one, the real game changer, it arrived very recently, December 22nd, 2025.
Okay.
The FDA gave its approval for the oral version of Wegovy. So, a pill. It uses the exact same proof and molecule semaglutide, but in a pill format.
And the analysis is calling this the holy grail.
It is. I mean, many analysts are. This isn't just another product release. It's a fundamental shift.
The holy grail. That's some high praise. But we've had pills for other things for years. Why is taking this from a weekly pen injector to a daily pill? Why is that such a game changer for the market?
Because it's a complete revolution in patient psychology and market access. Just think about the single biggest barrier that stops millions of people from even starting these treatments.
The needle.
It's the needle. Whether it's a real phobia or just discomfort or that psychological hurdle of self-injecting, that one thing has kept a massive demographic out of this market.
Right.
By offering a proven treatment in a daily pill, Novo Nordisk just completely removes that barrier. They are opening the doors to a whole new group of users who previously just said, no thanks.
That makes a ton of sense from a market reach perspective. But if the news is really that big, the market didn't exactly react that way.
No, it didn't.
The stock only popped, 7 to 9%? If the implications are this massive, why is the price still, as the report says, massively beaten down?
And that is the core puzzle the analysis is trying to solve. The report argues the market is just suffering from this deep skepticism, maybe even tunnel vision, that's just focused on the competition. They think the market is slowly, almost reluctantly, waking up to what this really means, but the stock price just has not caught up.
And this gives NVO a huge advantage, right? I mean, competitors like Eli Lilly, they're working on their own oral drugs, but NVO is first to market with an oral version of a molecule, semaglutide, that's already proven.
Already has massive brand loyalty and years of real-world data. It's a huge, huge head start.
Right.
They aren't trying to sell the market on a brand new compound.
They're just taking the trust they already built.
Exactly. Taking that trust from Ozempic and Wegovy and just putting it into a more convenient format. It's the best kind of first-mover advantage you can have.
So, if the psychological barrier is gone, let's see if the numbers back this all up. Let's pivot to the financials, because this is where the valuation disconnect seems, well, absolutely staggering.
It is. It's the strongest part of the whole argument. And it's all about the price-to-earnings ratio, the PE. If you look at Novo Nordisk's current PE, it's sitting somewhere around 14x to 15x.
14 times earnings. For a global leader in a hyper-growth market, that sounds incredibly low. What's the historical comparison, and what about their main competitor?
Historically, NVO stock usually traded at a PE multiple between 25x and 30x. So right now, it's at half its historical average.
Half. Wow.
Now compare that to their main competitor, Eli Lilly, ticker LLY. LLY is currently trading north of 50 times earnings.
50! That is just mind-boggling. You've got NVO at 14x, LLY at over 50x. They're in the same revolutionary market, a massive growing duopoly, but their valuations are miles apart.
And the analysis report doesn't mince words here. It says that the market is pricing NVO like a dying legacy pharma company, while at the same time, it's pricing LLY like a high-growth tech stock.
The report says that gap is just unsustainable.
Completely unsustainable. Massive mispricing.
Okay, but let me play devil's advocate here, which we have to do. Why should NVO automatically jump up to LLY's valuation? Maybe the market sees real problems like manufacturing capacity or something that justifies a lower number. Why should we just assume this mean reversion will happen?
That's a fair point, and the report actually addresses that. They argue you don't even need NVO to match LLY. The upside comes from NVO just normalizing to its own history.
Ah, okay.
Even if NVO only gets back to a moderate 20x PE, which is still well below its historical average, that move alone would imply a stock price of $70 or more.
$70 from 52. That's a 35% upside just based on sentiment normalizing before you even factor in the new growth from the pill?
Exactly. And the most compelling part is that NVO is not a stagnant company that deserves a 14x multiple. The company is projected for really strong double-digit revenue growth.
What are the numbers?
We're looking at estimates between 16 and 24% growth for 2025 and 2026. And on top of that, their gross margins are elite, just hovering around 83%.
So if you put that all together, you're buying a dominant player, double-digit growth, 83% margins, but you're getting it at a price for a slow-moving utility company. The numbers are just screaming undervalued.
It's the definition of a high-growth monopoly, duopoly player at a value stock price. That's the whole thesis.
Okay, so let's check the charts. A great story needs technical confirmation that the bottom is actually in. What's the technical analysis telling us?
The technical setup really supports the fundamental story that the worst of the selling is probably over. NVO is in this brutal 6-month downtrend.
Right.
On the chart, this created a classic reversal pattern called a falling wedge. And a falling wedge usually means the sellers are just getting exhausted. They're running out of steam.
And was there a clear support level?
Yes, and this is crucial. During all that panic, the $45 to $50 zone acted like concrete support. The stock just refused to break lower, even when the fear was at its peak.
Wow.
That tells you institutions saw a floor there.
And the FDA approval was the spark that confirmed the reversal.
Exactly. The breakout above $52 on much higher volume, that confirmed the trend reversal. And for people who follow charts, this is really interesting. There is a massive gap on the price chart back up toward the $70 range.
And gaps like to get filled.
They often act like a magnet.
Yeah.
The price will want to fill that gap once momentum shifts. And that technical target lines up perfectly with the $70 fundamental target we just talked about.
That technical setup makes the whole thing feel a lot safer. But safety also means financial stability. If they're going to meet all this new demand, they need cash to scale up. Are they financially sound?
They are an absolute cash flow machine. Their financial health is rock solid. We're talking about free cash flow of around $8.5 billion.
Which is huge.
It's crucial. It means they can self-fund the massive manufacturing expansion they need for both the injector and the new oral products. No need to dilute shares or take on a bunch of debt.
And the balance sheet itself.
It's clean. Very low debt. A healthy debt-to-equity ratio of about 0.6. And on top of all that, for the long-term investor, the company pays a respectable 3.3% dividend.
So it literally pays you to wait.
It pays you to hold through the volatility while you wait for the market to catch up.
Okay, that solid footing is essential, but we can't ignore the elephant in the room. The whole reason the stock got beaten down in the first place, we have to address the bear case. What's the number one fear?
The overwhelming fear, the one driving everything, is that Eli Lilly is just going to crush them. The whole narrative is built around this winner-take-all idea.
That there can only be one.
Right, that only one company can really dominate this market.
So how does the analysis push back against that?
The rebuttal says that this zero-sum thinking is just fundamentally flawed. The obesity market is projected to be $100 billion, maybe more.
It's a massive pie.
A massive pie. It is not a winner-take-all market. There is plenty of room for two giants, NVO and LLY, to both be incredible growth stories for years. The report says NVO is priced right now as if it's going to lose everything, which they call absurd.
That makes sense. Splitting a $100 billion pie is still pretty good.
Let's be.
What about the other big risk? Generic competition. Patents don't last forever.
Yeah, the concern is that cheaper generics could pop up, especially after 2026, targeting the original injectable versions. And the analysis acknowledges that risk is real for the older patents.
What?
But there are two key shields for NVO. First, just immense brand loyalty with Ozempic and Wegovy. Doctors and patients don't like to switch off something that's working. And second, and this is way more critical, the new oral pill is protected by fresh patents. That new oral patent creates a massive moat for years to come, securing their share of the new format that everyone is pivoting to.
So if the valuation is off, the catalyst is here, the chart looks good, and the finances are solid. Let's bring it all together. What is the final practical verdict from the analysis?
The analyst consensus, even with all the fear, is a clear moderate buy. And the price targets are aggressive because they assume that PE gap will close. Short-term targets are around $65,
Filling the gap.
filling that technical gap, with longer-term targets stretching to $90 and maybe even higher if that historical 25x multiple comes back.
That's some significant upside. So for our listeners, what was the actionable advice? How should different types of people approach this?
It was broken down into two camps. For long-term investors, the people looking for that, set it and forget it trade over the next 12 to 18 months, the recommendation was simple. Accumulate heavily in the $50 to $55 zone.
Okay. And for more aggressive traders?
For them, the advice was to buy the confirmed breakout above $52, but to be very strict with risk management. Use a tight stop loss right at that $48 support level. The idea is to catch the big reversal, but get out quick if the fear comes back.
Powerful analysis. But let's leave our listener with one final provocative thought. It kind of gets at the tension that's still driving this whole thing. We've established NVO has the proven molecule, the great margins, the cash, and now the holy grail oral pill.
So this raises the ultimate question you have to ask yourself.
Yeah.
What factor, precisely, is still causing these huge institutional investors to demand such a radical steep discount for NVO? A 14x PE. Is it a real belief they can't scale manufacturing fast enough? Is it some historical baggage from the injector format? Or something else?
Because figuring that out.
Understanding the psychological or operational roadblock that is still holding that PE down, that'll be the ultimate key to knowing exactly when this valuation gap finally and dramatically closes.